For over 50 years, the global financial system relied on the SWIFT network to route international payments. SWIFT, or the Society for Worldwide Interbank Financial Telecommunication, is a global messaging system used by banks to securely transmit financial instructions. By 2026, that architecture has been displaced by Internet-native value transfer layers. The core mechanical limitation of SWIFT is its reliance on IOU messaging. It does not actually move money. It sends instructions across a fragmented network of correspondent banks, promising that money will eventually move. Executing these instructions requires a multi-day reconciliation process across pre-funded Nostro and Vostro accounts. For corporate entities, this means capital sits trapped in transit for 3 to 5 business days. Stablecoins replace this asynchronous process with atomic finality. Because stablecoins function as the digital money itself moving across a unified ledger, the transaction and the settlement occur at the exact same moment. The legacy system reached mathematical obsolescence. In an environment of 24/7 global commerce, enterprises adopted atomic ledger settlement as a strict mechanical necessity to maintain liquidity. In early 2026, the volume of real economy stablecoin payments reached $4.2 trillion. Institutional adoption at this scale followed the Great Formalization, the emergence of enforceable regulatory frameworks. These laws provided the bank-grade certainty required for corporations to integrate digital assets into their core operations. Governments established compliance moats that mandated high-quality reserve backing and clear redemption rights. This process transformed volatile crypto assets into predictable funding rails. Treasury teams now integrate these rails directly into their enterprise resource platforms, constructing a sovereign financial stack that provides exact control over liquidity and instant transparency. Regulation provided the legal bridge, allowing stablecoins to shed their status as retail speculation and function as core institutional infrastructure. Traditional cross-border payments suffer from compounding operational friction. A single corporate transfer must pass through a chain of intermediary banks, each performing independent asynchronous AML and KYC checks. AML and KYC stand for Anti-Money Laundering and Know Your Customer, regulatory protocols designed to verify client identities and prevent illicit financial flows. This chain is highly fragile. Between 4 and 6% of all legacy cross-border payments fail or face delays due to missing documentation and messaging errors. This comparison table shows the contrast in settlement efficiency. Legacy correspondent banking averages 3 to 5 business days, while stablecoins achieve finality in under 3 minutes. Traditional transfers hide up to 7% in fees, whereas stablecoins compress costs to under 0.5%. By settling at network consensus speeds, T+0 infrastructure eliminates the last-mile reconciliation delay entirely, neutralizing the counterparty risk inherent in correspondent banking. Achieving near-instant finality means capital is never trapped in transit. Corporate treasurers can reduce idle buffer capital and execute highly precise cash flow forecasting. Public blockchains recorded $62 trillion in annual stablecoin transfers in early 2026. However, only 7% of that total, about $4.2 trillion, represents real economy payments for goods and services. The remaining 93% is largely driven by bot-driven trading, derivative collateral management, and protocol-level routing. This segmented donut chart isolates the true engine of adoption. The business-to-business enterprise settlement sector accounts for 40% of all real-world stablecoin volume, and it is growing at an aggressive 65% annually. Activity is heavily concentrated in the Asia-Pacific region. Singapore, Hong Kong, and Japan process approximately 60% of total global stablecoin payment volume, handling $245 billion in Asian-originated flows. These hubs formalize their legal frameworks early. This regulatory maturity provided shipbrokers and manufacturing conglomerates the legal certainty to deploy digital settlement years before Western markets caught up. In the United States, the Genius Act established a strict federal mandate requiring payment stablecoins to be backed one-for-one by high-quality segregated reserves. The Office of the Comptroller of the Currency bifurcated the market based on systemic risk. The OCC is an independent bureau of the U.S. Treasury that charters and regulates national banks. Under this structure, federal qualified issuers handle systemic financial flows with no market cap limits, while state-certified issuers are capped at $10 billion in outstanding tokens. In the European Union, the Markets in Crypto Assets Regulation, or MiCA, went live, eliminating a fragmented patchwork of 27 different national laws. Under MiCA, Electronic money tokens, stablecoins pegged to a single fiat currency, grant holders a permanent right of redemption at par value. This provision secured passporting rights, allowing authorized issuers to operate across the entire single market. By enforcing bank-grade reserve disclosure and eliminating legal ambiguity, the US and EU authorized stablecoins to serve as the primary settlement layer for global trade. The United Arab Emirates implemented the Payment Token Services Regulation, proactively positioning Dubai and Abu Dhabi as primary jurisdictions for Sharia-compliant, blockchain-based settlement. This flowchart maps the UAE's emerging infrastructure. The USDU token, for example, is registered for regulated digital settlements between institutions, with a strict mandate that all backing reserves remain held at local major banks. Central banks often fear deposit displacement, the risk that digital currencies will drain liquidity from commercial banks. The UAE's local reserve mandate successfully offsets this risk, keeping capital within the domestic banking system. Recognizing the shift, global Tier 1 banks moved from resisting digital assets to issuing tokenized deposits, capturing high-margin revenue from stablecoin custody and reserve management. Traditional institutions realized that operating legacy messaging networks no longer conferred an operational advantage. Survival required orchestrating the new blockchain ecosystem rather than fighting it. In traditional banking, the float is the time during which funds are in transit and unavailable to either the sender or the receiver. Banks historically monetized this transit time at the corporation's expense. T+0 settlement eliminates the float entirely. This efficiency enabled yield on demand, allowing treasurers to instantly deploy surplus cash into institutional-grade DeFi protocols to earn interest. DeFi stands for decentralized finance, an ecosystem of automated financial applications built on blockchain networks. This logic tree visualizes programmable treasury automation. Using smart contracts, enterprises configure surplus subsidiary cash to sweep into central yield accounts automatically. Payments are held in escrow and released to suppliers only when an IoT delivery verification triggers the execution. The Internet of Things, or IoT, is a network of physical devices embedded with sensors that exchange data over the Internet. Compliance scripts embedded directly into these workflows automatically enforce multi-jurisdictional sanctions and travel rule data on every single movement of value. Stablecoins allow the corporate treasurer to extract revenue directly from operational infrastructure. By automating workflows and capturing on-chain yields, the Treasury function now operates as a primary liquidity architect within the enterprise. This network map illustrates a primary operational hurdle: liquidity fragmentation. Stablecoin pools are isolated across multiple independent blockchain networks, creating bottlenecks that restrict efficient capital flow across certain geographic corridors. Furthermore, the lack of fungibility between different bank-issued tokens and private settlement networks creates walled gardens, threatening the basic economic principle of the singleness of money. The slow nature of legacy banking provided a safety net where mistaken payments could be frozen. Atomic finality is irretrievable. This absolute permanence requires enterprises to utilize MPC wallets. MPC, or multi-party computation, is a cryptographic technique requiring multiple distinct parties to authorize a transaction, eliminating a single point of failure. Regulators also identified a severe macroeconomic contagion risk. A sudden run on a major stablecoin could force an immediate fire sale of underlying sovereign debt, destabilizing the broader bond market. The sheer velocity of atomic settlement removes all margin for operational error. Cyber vulnerabilities and isolated liquidity pools scale rapidly into acute, systemic risks for the enterprise. Everyday spendability remains limited by accounting constraints. In many jurisdictions, executing a commercial transaction with a stablecoin triggers a complex capital gains tax event. Despite these frictions, public and private digital money are actively converging. Central banks are developing synthetic CBDCs, private stablecoins fully backed by central bank reserves. A CBDC, or central bank digital currency, is a direct digital liability of a central bank, available to the public or commercial institutions. Stablecoins provide the liquid medium for settlement, while tokenized RWAs serve as productive collateral. RWAs, or real-world assets, are traditional financial instruments like bonds or treasury bills, converted into digital tokens on a blockchain. This synergy is projected to drive an $11 trillion market by 2030. Enterprises that integrate their own sovereign financial stack now control their own revenue infrastructure. They utilize internet-native value transfer as the foundational layer for all global trade in the 2026 economy.